Today we're going to be talking about who's in the money and who's trapped. Stay tuned, traders. We'll be right back. Good day, traders. Stacey Burke from Stacey Burke Trading. Today we're going to be reviewing our simple 12 candle model. We're going to do a brief discussion on psychology, but we're going to be talking about who's in the money and who is trapped. And that's one of the most important things that I look for every single day. We're going to review the high and low of the day approach to the market. I've been mainly focused on gold, but also following the pound and the euro pairs each day, looking again to see if that simple model shows up in our timing window day in and day out, offering asymmetrical risk-reward trades. It may only be 25, it may be 50. We've had some excellent trade setups this week. Heading into Friday, Good Friday. Obviously, Thursday may be the last trading day for all of us, depending on where you're located in the world. Before we get started, I'd like to just say thank you to everybody. And again, thank you for a ton of great feedback and comments. A lot of people getting value from the shorts. I appreciate the comments and feedback there as well. Take a second for me and just hit the like button. Turn on your notifications. Again, that just helps the algorithm keep generating a lot of new traders into our course and our class. And again, just looking at helping as many traders as possible and inching 1% better every single day, not only in my own trading, but helping other traders do the same. There's a lot of garbage out there, a lot of nonsense. And today we're going to review, again, my simple model. Everything is about simplicity. If you can't reproduce your own behavior, and understand that the only constant in the market is yourself, and that if you are going to the screen each day trying to figure out what the market's going to do without a model that you can constantly reproduce and duplicate and then scale up in size, you're going to go through that endless cycle of pain, frustration, euphoria, and then capitulation, or hopefully not blowing up your trading account, but again, understanding some very basic concepts about trading the markets. There's nothing tricky really about it. It's as tricky as we want to make it. And again, I know in my own approach, my own learning, my own mistakes in the past, blowing up several accounts, some very, very, very down times, and coming back and clawing my way back over 20 years of trading. And when I tell you these things, I can tell you with absolute certainty that they show up every single day in the markets. And again, just there's going to be a learning curve, but let's review this, let's keep it simple, and let's keep getting better. So I talk about using the 15-minute charts. Now, obviously on gold, I look at the 1 minute and the 15-minute charts together, but my approach is still based on the same model, working from the high and the low. Now, the most important, as my day begins, the most important two areas that I'm concerned about are the previous day's high, the previous day's low. The market will often go into consolidation, into the rollover from the US, into the close, and the market typically will be usually within a 25 pip box on the major pairs. On gold, sometimes it may be in a 50 pip box. But the most important thing that I look for that really gives me an understanding is when they get to one of these levels. Now, oftentimes there's a fantastic trade out of this consolidation. Now, that consolidation will often be 15 to 45 minutes in one direction, possibly putting a high in place before they lock it in and come down and hit stops. Or we may see 7.5 and 15 to 45 in the other direction. We could see a consolidation that lasts into the second hour before coming out and triggering one of these previous daily levels. Now, we talked about this briefly in one of the last videos about thinking like the banks. Now, if you're trying to chase pips, this is how a lot of traders get chopped up. They get caught into false moves. They end up trading in both directions or taking trades and getting chopped up in both directions, getting frustrated, putting more leverage on a trade to try and get back to the high water mark or get even or get their money back that they may have already been chopped up in. And again, understanding that when the day starts, on the majority of days, I am looking at a minimum of 15 to 45 minutes before that market is even going to be potentially set up for me to trade. Now, in some cases, we will get a trade in that first 15 minutes, but typically that's after 2 hours where the market has given us a trade setup in that rollover time. So in understanding that if you are moving large volumes of money, so remember what I'm addressing for myself is where would size be able to be put into the market? Now, if we talked about this in the last video, trading and thinking like the banks, yesterday's high, yesterday's low are areas where they will proceed to not only hit stops on people who may be in the market in that rollover time into the close of the session for 25 to 50 pips, but also that triggers other time frame traders into the market. We've got institutional money, hedge funds, larger positional traders. We've got retail traders that may be trading off of the previous day's high and lows, breakout traders, reversal traders, all of those types of possibilities there. Take profit orders. So it's very important to understand that as we trigger those larger time frames, now we get larger volumes swelling into the market. Now, we're not even going to get into this just yet, but that's not even including our weekly cycle, okay? Weekly highs and lows, but also our template for 3 days of rise, 3 days of drop. We're at the low of the year on gold. They went within 10 pips of the low of the year before reversing and going back up to over 250 pips. So the question you need to be looking at each and every day, even into the rollover when they go into the consolidation, is who's in the money and who may be trapped. So when we look at a position where somebody's trapped, we get traders with their indicators, their EMAs are coming down, and they're shorting the market down here somewhere, possibly. And that may be a trend setup. So we come back to the three things that markets do. They trend, they break out, they pull back and continue, or they false break and reverse, or they stay in a trading range. But if you're selling low, and again outside of our timing window, or potentially at the end of a timing window, you may be the trader now who is potentially going to be trapped. The trader who sold up here somewhere is in the money. So as we head into our gap times, we may get a situation where heading into the end of the session, into the next 12 candle window, we now have a move that possibly has locked in a low with an engulfment or a pin hammer, and the trader down here can't get out of that trade. So he's got a situation where he's hoping the market comes back. He's in a hope trade, but the market seems to pull further away. Now, when a trader's trapped and this trader's in the money, the first place they're going to go, if they are going the other direction, is to the other side. Now, when we trigger a previous day's low, the first place they're going to go is to the high of the current day, if they are going to indeed reverse. Low of the day, high of the current day. But if this market is going to reverse, as we saw in gold yesterday, they may, in the next session, the middle session London, make a new high and make a new low. And then prior to the US market opening, they will go back to our master pattern where they hit the stops, and then they trend. And we're going to look at that example from yesterday. We saw some very similar examples on the pound and the euro where they made a low, they pulled it back in a 25 pip range, they went back a second time and they hit that low at the beginning of the 12 candle window. So again, reinforcing, we worked from the low and the high of the day. On the pound, they went into a previous day's engulfment, formed a low, and then hit it a second time, meaning they had already locked in that low, potentially for the week. Round numbers, double zeros, 50s, 75, and 25. Now, people have been asking me, where am I getting these numbers from? That is the price on the chart. Now, I use the Sweet Spots indicator. It's a free download in the link below for MT4. You can draw the lines yourself. When you're inside of round numbers, just draw the lines. But those numbers are the actual price. I didn't just put a 50 pips on a box. That is the price numbers. Engulfments and pin hammers. Engulfments will lock in a high or a low. So again, when we get to these levels, how does the market behave? It's always about how is price behaving. Somebody's going to be in the money, somebody's going to be trapped. Now the goal obviously is to not be the person who's getting trapped down low or trapped up high if the market is going to reverse. And if we're trading in a reversal, we want to be buying low in an uptrend or selling high in a downtrend. And that's as simple as that. I look for one really good trade setup in having a thesis heading into the market session. And if that market opens up differently than what I'm expecting, then I stand back and I revisit that thesis and I look at the bigger picture on the 15-minute charts. I may sometimes glance to the hour or the 4-hour, but again, coming back to my weekly highs and lows, am I up high, am I down low? Have we already broken out of a previous week? It's the same thing. Okay, on a weekly chart, we're either inside of a range, in a trading range, we're down low for buying, up high for selling, or we've already broken out of a week's high or low, triggering other time frame traders, and we may be in a second week trade, or as we saw this week on gold, a reversal from breaking out of a previous week's low, retesting the low of the month and the low of the year. One bar stop, depending on what time that happens, we may be looking at a 25 to 50 pip profit target. Again, if we're inside and it's 50 pips to the low, they may get down there and that may be where that trade stops. If it's a 25 pip box, we need to watch that and watch how price behaves. And again, in most cases, most stop hunts will be 25 to 50 pips above or below the initial range. So when we're in a weekly template, Monday, Tuesday, Wednesday, we could be going three lower lows. So we might be breaking a low, pulling back and rolling over. The next day, again, goes into consolidation. They get traders chasing the long when what they're doing is they're putting in a peak formation for that session and then triggering the low, hitting the stops on traders that might have gone long into the close. So again, who's in the money, who's trapped? Keep it as simple as possible. We'll look at some examples on the charts. As simple as you make it. If you're working from the extremes, if we're inside, if the market stays inside for a couple of hours, again, I'm working from the high and the low, which means that they're either going to work into a low, make a low, work back into it. If they're working into it, then of course I'm looking for my W reversal. If they're working up into a high and not going anywhere, then I'm looking for my M formation. So coming back to the really simple concept, they make a high, they make a low, and then they're either going to go back up and work the high for a stop hunt down, and they may come back inside. They expand the range on both sides, trend the market. It could be a simple setup where they make a high, they make a low, they break out, and they trend, which typically we will see after there's already been a trend movement up. They move it down prior to the 12 candle window and the market forms a bottom, locks it in, and continues a move, retesting the highs, hitting stops, potentially putting a new high in at some point in that session, and then reversing. So let's take a look at that. Again, thanks for a ton of great feedback. Keep it simple, traders. The simpler the better. You can reproduce that, you can duplicate it. But again, simplicity, high and low of the day, the timing window, Asia, London, New York, round numbers, double zeros, 50s, quarter levels for trap volume, engulfments, pin hammers, a one bar stop. Just to focus on this right before we finish up, if you are risking a certain percentage, 1%, 2%, 0.5%, 4%, whatever that may be, if you risk that on and you're looking for one really good trade setup per session, it's impossible to blow your account up unless you start to get caught into emotional, irrational, impulsive errors. You go to the screen, you start trading in here, you're getting chopped up, you're trading in the gap times inside of the high and the low. The algorithm will chew you up. That's what the market tries to do, is entice you into things that it will force you or cause you to engage in erratic behavior. That's how trading accounts get blown up. I know that firsthand. So go to the screen prepared mentally. Psychology, all these different things about why we lose, fear of loss, all those different things are fine, but you need to work on the trader who you believe you should be. So if you're calm, cool, and collected, you're prepared, you have a plan, you go to the screen knowing exactly what you're looking for. reinforce that vision in your mind of who you are as a trader. So if you go and study some of these great actors, these method actors who have played some extreme roles, Christian Bale, Nicolas Cage, Jim Carrey, if you read about some of the roles that they took on and how they transformed themselves into that character, that's how you need to think as a trader. You can do all the psychology study and reading and everything else, but you actually need to transform yourself and your mindset as a trader to be able to think about how to make money and how to trade that. And taking losses is the most important part of being successful over the long game. So have a think about that. Trade management, again, I don't go to break even until that market has cleared the quarter level. If I'm shooting for 25 pips, I keep my stop in place until it hits that quarter level. But if I'm going for 50, it has to go through that quarter level before I go to break even. And obviously in a fast, impulsive stop hunt, that market may already move 25 to 50 pips in 15 minutes. So hopefully you got value from today's video, traders. Focus on making money, in the money or trapped. There's two traders always in the market. Somebody's underwater, somebody's in the money. And the market's going to either keep going and bending the arm of the trap trader, and this trader's going to be increasing their profits, or they're going to be trapping traders into the market, chasing that original move and going back and stopping out or hitting the stops of the traders who are in the money at break even or reversing and going for a bigger loss. So stay disciplined, stay focused. Keep getting better, 1% better every single day. Have a great trading session, and may the markets go with you.
So asking ourselves each day is who's trapped and who's in the money, and that can be into the rollover, that can be into the next session. Every time we want to be looking at, is the market already in a trend? Are we at a breakout pullback for a reversal, or is this a breakout pullback for a trend continuation, or are we just in a trading range? Again, just looking at gold each day, I'm asking myself that question heading into each window. And in the rollover, we had last week's, if we go back and look at the previous week on gold, we can scrunch our chart up. We had a narrow range week, and we had our low of the week on Thursday, Friday, basically the same. And on Monday, if we zoom in again, coming into our session, the market went up. We go back to our basic pattern. We have a high, we have a low, and the market in the initial expansion came down. We started up between 25 and double zeros, but the market worked its way down. And again, the market's going to be in a tight consolidation. They're going to be crafty. They are trying to entice traders in both directions. In this inside, we're inside of the high and the low before moving up in the first 30 minutes up to numbers, up to the quarter low, and then giving us a pullback bar, a doji, and a stop hunt down inside. So again, we talked about the previous day's high and low, attracting other time frame traders, larger volume traders, bigger money, all that sort of scenario. But also we look at who is in the money. Who's in the money? We have the trader from the U.S. session who's traded off of the low of the gap time, the low of the day. They jam traders in, forming a nice short and W inside of the peak formation for the 75 pip move up. They go into consolidation. Okay, stop hunt down. Who's in the money? Now, this first trader's been caught in the false move. So coming back to our master pattern, if you're not sure what that is, just go back and review the video on the master pattern. They make a high and a low. They hit the stops. They hit the stops. They move the market. On a smaller time frame, this trade was set up on the 1 minute chart. But again, the simple concept. Coming to the screen each day, round numbers, highs, previous days, high and low, who's in the money, who's trapped. And this first 15 to 45 minutes will often work one side, enticing traders into a false move. And that false move sometimes may be a 25 pip move. And as we can see this morning, or on this particular morning, the Monday morning, the market's inside of a 25 pip box. So when we're inside, I don't even look for a trade. I'm looking for something off of numbers. But we go down 50 pips. They hit the stops. They give us a bullpen hammer inside. So the market has not gone outside and triggered a daily high and low. The stop hunt has been down inside, which gets traders going long, assuming that this is going to be a trend trade back to Friday's high. But we get back to the high of the day. The market goes back to the high of the current day and goes sideways before giving us a bear pin hammer and then eventually an engulfment of the high bull pin back inside of the 00 box. So again, this isn't our gap time, but now we have possibly a market giving us a thesis heading into the next session. So the market's either going to go down to the low of the day and give us a reversal pattern, or we're going to be in a breakout pullback scenario that evolved over between the London and the US session. So understanding that sometimes the market, and again, this is the low of the week, we're inside of the previous day's high-low. The market went down and made a low of the day, back to the high of the day, but again, we worked back down towards the low of the day. It breaks out, it pulls back, it breaks out, it pulls back. So traders that have shorted this, again, the stop hunt into the gap time and the US Open is into traders that have shorted this breakout before consolidating at 50 and eventually pulling away. So again, the market on the smaller time frame initially gets the first mouse chasing the move down. They hit the stops on traders that are long in the gap time. They go back up, hit stops on traders that are short from the gap time before dropping down, pulling back at the equities New York Open, and then continuing that move down. We head into the next day. Again, understanding that the low and the high of the day, we've got one big day down. We've broken the previous week's low. We're not even going to go to the daily chart, but on the daily chart, we'll take a quick look. We had lows of the month and of the year down around 16,767. So coming back to our 15-minute chart, we have one day down. The market pulls back and goes into consolidation. And again, you've heard me say this before in many videos, 3 levels of rise, 3 levels of fall. Often the pullback will be 50 to 75 pips from the previous day's extreme. That gives us some insight when the market goes into consolidation in the next session. Is the stop hunt high or is it low? The market, if we think it's going to go down, we would expect a 25 to 50 pips stop hunt high, and then locking in a high, coming down to continue our downward movement. We get a 25 pip stop hunt, again 15 to 45 minutes, establishing a high of the day before going sideways and then coming off the quarter level after hitting stops on traders that were short, but again understanding the market does not have to go and take out the high. This trader was up 25 pips. They've come up and gone negative into that trader without hitting their overall stops, but they now potentially have been stopped out at break even, or they've been scared out of the trade. They may have had size on that and they got out of the trade because they didn't want the market to stop them out with a loss, or they may have already taken 25 pips into the close and they're ready to get back into this move. The market comes down and triggers breakout traders. Triggers breakout traders, and typically you've heard me say that when they get other time frame traders in the market, they will often put 50 pips on gold, especially into traders on 4-hour daily charts. Well, we see this market stay consolidated. So again, and looking at this from a push perspective, we have 1 push, 2 pushes, 3 pushes against the downward move, which again, understanding we've got a high and a low in place, the market makes and goes into consolidation, and it makes a high and it makes a low, and we go back to our master pattern. They hit the stops, and the trend continues. So understanding who's in the money, so this trader's in the money. Now traders that have gone along, we don't know this until the longer the consolidation holds, and then the way price behaves into the open of our 12 candle window gives us some insight. This engulfment reversal, traders maybe have gone along here thinking they've locked in the low of the day, but the next candle reverses the second candle of that first hour, and then we get a straddle candle. We'll zoom in on this. So continuation for the short trade, but this candle also straddles not only the original breakout of the low, so again, traditional breakout traders, this completes the breakout pattern, but also straddles our 50 box inside of a 00 100 pip box before continuing, pulling back, pulling back into consolidation, and we get our type 3M at the low of the day for a continuation into the US session. So again, traders are in the money. Anybody counter trending is getting caught. They're trapped. The next bar after taking a long trade on any one of these bull candles, you're immediately underwater. When traders see that, so again, even if you're managing a trade, this is an opportunity to either go to break even, or if you're adding second positions in, I talk about shorting bull candles in a downtrend or buying bear candles in an uptrend. We go back into consolidation. Important to understand again that this previous day's lows and highs are where other time frame traders will be entering the market. So this is fuel for either a reversal or a continuation. We had one day down breaking out of our weekly low, second day down triggering the low, but the pullback is very weak. We get 3 pushes against the breakout and then a continuation move. The difference from yesterday, we see a fast 50 plus pip stop hunt to the low, triggering stops. They pull it back, 1 push. They hit it a second time, and they pull it back in the gap time, and they hit it a third time in the last hour of Asia prior to our 12 candle window, and we get the engulfment for a W reversal formation. Okay, so the difference is now we're in the gap time. This market has given us a W formation, but think about what's happened here. We talked about the low of the month being down at 17,767 or 16,767, roughly in this area. But the market gets people chasing the short move down, and then bang. Now, everybody underneath of that engulfment is trapped. The previous day, everybody underneath of this engulfment is trapped except the next bar. The bull candle is trapped. The engulfment, the next bar, this trader's in profit still. They give you a false bullpen reversal that makes it look like it's a stop hunt for a continuation down, but the next bar goes up. We're entering into our 12 candle window. We are now in a breakout off the low of the day after 3 pushes and an engulfment. So 3 pushes were against the trend the previous day. The 3 pushes were down into the previous day's low. The first place we're looking at is the high of the current day. They trigger other time frame traders. If traders have shorted this on the follow through down low as the 12 candle window opens, all of these traders are now trapped. They are all trapped, which again comes back to understanding they go back and hit the stops and pull back inside. They go back in the gap time and they hit the new high of the day. So now when traders ask me, where's your high? Well, how did you get that as a low of the day? Because when London traded now and they've gone back to the high, London has made a new low of the day. But we've also layered on top of all the traders that followed the second and third legs down who are now caught, if not stopped out, if they're averaging into a loser. Not only are they short at the low of the previous day, they're short at the low of the week, the low of the month, and the low of the current year. So this market then proceeds to stop hunt down into the New York Open, then stop hunt high before pulling back and consolidating. So again, hit the stops, back inside, and then trend the market. Now, this is not hindsight. This is high and low, timing window, previous day's highs and lows, who's trapped, who's in the money. The same things happen every day. Now again, coming back just to structure. Okay, we could look at a minimum of 2 times this market expansion if this was to move fairly strong. We could also do the same thing for the London US Open, 2 full expansions. Or we can look at this as a 100 pip box and look at 2 times that box as a possible range expansion. The market obviously exceeded that and went up 50 pips above. We come into the next day. We'll zoom in. We have a low formed into the close of the session. The market worked above that low bear high. So again, we go into consolidation. The market locks this in as a low. 1 push, 2 pushes before engulfing into the open. So again, we have a high. They come down and they work the low from the previous night's close. The market forms a low of the day. We get a middle structure for a W reversal, and we get an engulfment. The market fails to get down to 50. We're almost 100 pips from the previous day's high. So again, a pullback, 50 to 75 pips. This has exceeded that somewhat, but we've gone below the quarter level. I talk about the quarter levels often being an area to lock in or trap volume. Obviously, it can be a 50 pip box, but we're below 75. They work the low, work the low, work the low into our second hour, second candle, second hour. So this is a market profile, a false break reversal at the beginning of the hour. They engulf it. Next bar is a bullpen hammer, but this engulfment locks in the low. It's a 1 bar stop. Now our initial target, we've locked in the low of the day. We're going to obviously hit the high of the day. If that market breaks through and holds, breakout pullback, we expect that this market will continue and hit the previous day's high, not only to hit stops, but potentially to trigger other time frame traders, again attracting larger institutional players into the market. Now, will it get there? I don't know, but we will watch how price behaves as we head into the next 12 candle window. So again, we go into consolidation. The market sets a high, it sets a low. It eventually locks in the low, so it hits the stops. It hits the stops on the downside. Engulfment for the continuation back towards the high of the previous day. So if we look at the pound, we can again just look at, we're inside of the previous day's high and low. So we had an engulfment lock in the the low of the Tuesday session. The market then proceeds to work its way up in the rollover. So again, we have right off the first bar, the market starts to go higher. We're expanding the range higher. We work up into 50 to form a high of the day. The market then proceeds to go back down into the quarter level, and it gives us a low of the day. And then we work into that a second and then a third time with a bear pin hammer at the open for the fast explosive move back through the high of the day. So again, you'll notice that the peak formation low, 1 push, 2 pushes, a 1, 2, 3, and an engulfment locking in Tuesday night's low. So again, coming to the screen, traders can look at this and say, oh, we may see a low of the day form at the quarter level. How does price behave when it gets to the quarter level? They go up 25 pips, they expand the range up, they expand the range down. They work the low, work the low, work the low on 3 pushes into our 12 candle window for the explosive fast move up. They lock in a high. Traders short the market, and immediately the market reverses and gives us an engulfment at the high of the day at 50. We're engulfed above 50. Now the question asks, who's in the money and who's trapped? Well, when the traders shorted this engulfment, the first thing that they looked at was that this trader's in the money. They may have had a narrative that this would come back and stop hunt inside of the 50 to the trader who was long, except that we're into an existing trade and we're into the third bar of the second hour. So this is the first bar of the second hour. That is a low, that is a high. They come down and work into the low of that hourly bar. The next candle, the first candle of the third hour, immediately engulfs. We have a breakout pullback continuation. So again, understanding that even with your 15-minute charts, your 1-minute charts, you have to be thinking, the end of an hour, the beginning of an hour. How did price behave? This is an engulfment of the first bar. We have a breakout now. This is going to be a pin bar on the 1 hour. This market, this low, this pin, gets traders chasing the move long. They come back into the low of that bar. They form a high. they come back to the low and reverse off the low in the first bar of the third hour, the engulfment. Now the question is who's trapped? This trader clearly is trapped. This trader who's originally traded the move is in the money still. At this stage, this trader could go to break even. Now, I'm not saying this trader would have, if they've chased the move on the fill in the middle of a 25 pip box, well, they could go to break even. Certainly, the thesis is that this market should move quickly. Now, traders who were switched on that traded the break of the high, or if they were on a shorter time frame looking for a reversal after one push, two pushes, and then a third push down on the 1 minute somewhere underneath, especially after having pins underneath the quarter level, they may have been looking for something underneath in this area. They'd already be at break even, or have already taken 25 and they're looking at a continuation entry for the move back up. So again, who's in the money and who's trapped? Well, this trader clearly that shorted the market is trapped. And again, 25 pip box, they work the low, work the low, work the low. We're looking at a minimum of a full range expansion if the market breaks out and continues. The market puts a high in place in the gap time, comes down, forms a swing low, and then into our 12 candle window, gives us a reversal low off of that pullback. Now again, you'll notice the pin on that US session open comes down almost enough just to get this trader out at break even, who's traded the continuation move on the 15-minute chart. We get one push, two pushes, a middle structure, and a third push, and another bullpen hammer inside bar, in line with the initial move, knowing that there are stops and money sitting above not only the high of the day, but these lower highs that have chased the move down, expecting this market to blow back down through the bottom. Again, the market moves up fast and quickly, hitting stops to double zeros before pulling back inside, retesting the high, and then pulling back inside of the double zeros. So again, our initial premise is who's in the money, who is trapped. Traders who shorted this first bar thinking this market was going to capitulate on the downside. The next candle explodes, trapping them. If they didn't have a stop in place, now they're forced with either taking a bigger loss, or maybe they averaged into a loser, or whatever they did, I don't know. But this is called selling down low, and we want to be selling high or buying low. So again, if we go into today's session, we can see that the market has given us a high of the day structure, and we've worked the high, worked the high, worked the high in three pushes, but we're currently still inside of the quarter level, and we are between numbers, and we're down low in that quarter level box. So these lower highs may offer stops that traders may see hit if we were to revisit yesterday's high. So again, the market's come down low, formed a low, worked the low, made a high, worked the low, hit the stops up top. Again, the master pattern, they expand the range on the bottom, they expand it on the top. They've hit it a second time, they've pulled back into consolidation, but we are down low in a 25 pip box. If this market was to go back down, we would see this market break through the quarter level or squeeze down low for an explosive move back up on these lower highs and retesting the high of Wednesday. And again, looking at the euro, a great example yesterday. Market went up, and again, first bar right from the very beginning of the day. Okay, the market is in consolidation, but it starts to go up and expands the range on the upside. We go up to the 25 pip increment before, in our Asian 12 candle window, working down, and working down, triggering yesterday's low. Again, 4-hour traders, other time frame traders, daily traders, all of those are in. Once an end of day traders in the market, we know that the minimum probably would be their stop above the current high of the day. And again, where the market works down, pulls back, a second time works down, pulls back, and works down a third time into our Europe London 12 candle window with a bear pin hammer. So again, they formed a low of the day. They made a low, then they went back into it a second time, and then they went back into it a third time, and we had lower highs taken out in our third pullback, and then we have our stops above our bear pin hammer on our third push down after triggering the previous day's low. They immediately blow through the high of the day, a 2-bar pullback, and a bull reversal for a second hit to the high, and a 1, 2, 3. Again, our 12 candle window getting to the end. And on the euro, this trade, depending on where traders got in, somewhere 17.15, you're looking at 25 to 30 pips on this trade already. So again, on the euro, I'd be typically looking for a 25 pip move unless we had a large consolidation for a bigger move. But again, 25 to 40 pips in one session on the euro, I would be more than happy to take that. The market can go anywhere from 15 to 25 on a normal day. But just coming back to some simple things, they form a high of the day. So again, who's in the money? Well, obviously traders who have chased that second leg up are in the money. They have higher level lows for stops. And the importance of, again, just coming back to the importance of taking money off the table. When the 12 candle window completes, in most cases, they may extend it out like they did in the Asian window. They extended the low, but they didn't extend it much further. If you're in the money, you need to be counting these pushes. 1 push, 2 pushes. That third little inside bar is our third push. Take the money off the table, lock it in, come back later. They come down, 1 push, 2 pushes, 3 pushes down, hitting the low, stopping out higher level longs, and then we get an engulfment for our W reversal on 3 pushes for a retest of the high to where? To the 50 pip box. Round numbers. So again, 25 pips up. They pull it back inside. They hit it a second time. They pull it back. They hit it a third time before engulfing off of 50 for a 25 pip stop hunt down into traders that were long off the session. So who's in the money? Okay, you break the quarter level on the euro. You're holding on for a 100 pip move, but meanwhile the euro only moves 20 to 40 pips on most days. It may move more on some days, but typically on an average day, it's going to hit the stops. We've already taken out the high of the day. We've taken out all the lower level highs. And, a clean, fast move. It's over and done with. Come back the next day. Similar situation as the pound. They form a low. They go sideways. And now we watch and wait. I don't know where it's going to go, but I do know this. When the market heads into the 12 candle window, I'm going to watch how price behaves. Currently, we're going sideways at the quarter level. If we look at our week, this is Thursday, Monday, Tuesday, Wednesday. We've had 1 day down, 2 day down. This was our 3rd day down yesterday, and we're in consolidation inside of that quarter level, but also on top of the Asian range as we speak. So if it comes back inside, we may retest the lows of the week. If it stays above that quarter level, we're down low. These lower highs could be low-hanging fruit. We could see this market form a W formation reversal and retest yesterday's highs. Hopefully you got value from today's video, traders. Keep it simple. Don't gunk up your system and have analysis paralysis with all kinds of indicators and everything else. Keep it simple so you can scale it up in size and duplicate your behavior and your technical skills every single day. And again, looking for other time frame traders to give us some insight if there are larger players and bigger money behind some of these moves. Have a great session, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.